Wealth doesn't reward those who work harder, it rewards those who understand the game. You've been told that honesty, effort, and doing the right thing will eventually pay off, that if you just keep your head down, stay humble, and grind long enough, prosperity will find you. But here's the truth, nobody wants to say out loud. While you're working 12-hour days waiting for the universe to notice your virtue, someone else is playing an entirely different game. They're not working more, they're working the system. Machiavelli taught princes how to conquer power 5 centuries ago. This is the money version. And if you still believe that goodness generates wealth, stay with me until the end, because what you're about to learn will shatter that illusion completely. By the end of this, you'll have brutal clarity on the 3 Machiavellian principles that separate those who accumulate wealth from those trapped in the illusion of unrewarded effort. You'll understand why conventional morality sabotages your prosperity, how to transform perception into economic power, and which single decision determines whether you're a player or a piece on the financial chessboard. This isn't motivation. This isn't a pep talk about manifesting abundance or trusting the process. This is strategy, pure and unfiltered, the kind that works in the real world, not in self-help fantasies. The kind that makes people uncomfortable because it exposes the mechanics behind wealth that everyone profits from but nobody admits to using. I'm not here to make you feel good. I'm here to show you what actually works. Machiavelli didn't write The Prince to teach virtue, he wrote it to teach victory. And victory in the wealth game requires abandoning the script you were handed and embracing truths that sound harsh but produce results. The people who control wealth aren't better humans. They're not more deserving. They're not even necessarily smarter. They simply learned the real rules while you were being fed the comfortable lies. They understand that the market doesn't reward your character. It rewards your positioning. They know that perception is currency. They've accepted that being strategically ruthless beats being morally consistent when your family's future is on the line. This video exists because someone needs to tell you the truth, not the sanitized, socially acceptable version that keeps you stuck. The actual truth about how wealth accumulates, how power consolidates, and how ordinary people remain ordinary by clinging to principles that serve everyone except themselves. You have a choice right now. Keep believing the fairy tale that hard work alone will save you, or learn the principles that separate the wealthy from the wishful. Machiavelli was right about power, and every single thing he understood about controlling kingdoms applies to controlling your financial destiny. Let's begin with the first principle, the one that will make you question everything you were taught about being good. Most people believe wealth is the natural consequence of hard work, radical honesty, and doing the right thing. This belief is comforting, it's morally reassuring. It allows you to sleep at night feeling superior to those who cut corners or play politics, and it's completely, devastatingly ineffective. While you're operating under this delusion, convinced that your integrity will eventually be rewarded, others are operating in reality. They're controlling narratives. They're manipulating perceptions. They're building systems that generate money without their constant presence. They're not working harder than you. They're playing a fundamentally different game. And the most painful part, you were never taught the real rules. Nobody sat you down and explained that the economic game rewards strategy over morality, positioning over effort, and perception over truth. The emotional cost of this illusion is staggering. You feel morally superior but financially powerless. You watch people with less skill and less character accumulate more wealth, and it creates cognitive dissonance that eats at you daily. So you blame the system. You blame luck. You blame the privileged, the connected, the undeserving. You construct elaborate narratives about how wealth corrupts, how money doesn't buy happiness, how you're too authentic to play their games. These stories protect your ego, but destroy your potential, because the truth is simpler and more brutal. You never learned how wealth actually works. You were taught a children's story about meritocracy, while the real players were learning Machiavellian principles. You were memorizing motivational quotes while they were studying leverage, perception management, and strategic ruthlessness. This isn't your fault. The script you received was designed to keep you compliant, productive, and grateful for whatever crumbs fall from the table. Be a good employee, don't ask for too much, stay humble, wait your turn. These instructions serve the system perfectly. They produce reliable workers who generate wealth for others while remaining financially dependent themselves. The people who broke free weren't smarter or more talented. They simply recognized the script for what it was, a control mechanism disguised as virtue. They understood that playing by rules designed to keep you in place will never elevate you beyond your assigned position. The game was rigged from the start, but not in the way you think. It's not rigged against hard work, it's rigged against people who confuse hard work with strategy. Machiavelli didn't write The Prince to teach ethics. He wrote it to teach effectiveness. He understood that the world operates on power dynamics, not moral absolutes, and wealth is pure, concentrated power. The principles that governed kingdoms 5 centuries ago govern bank accounts today. Control the narrative, manage perception, build systems, choose allies strategically, adapt ruthlessly, create calculated scarcity. These aren't abstract concepts. They're the operating system of wealth accumulation, and you need to hear what actually functions, not what sounds beautiful. This video exists because someone has to say the uncomfortable part out loud. Your goodness won't make you rich. Your work ethic won't make you rich. Your intentions won't make you rich. Only understanding and applying the real rules will make you rich. Everything else is just expensive virtue signaling. Let's start with the first principle that Machiavelli understood deeply. Virtue doesn't pay bills. He taught that public virtue is a tool, not an end in itself. In the money game, being too good means being predictable, and predictability gets exploited, not rewarded. When you telegraph your moves with moral justifications, you hand everyone around you a roadmap of exactly how to extract value from you. They know you'll undercharge because you don't want to seem greedy. They know you'll over-deliver because you need to prove your worth. They know you'll accept less because you're terrified of appearing difficult. Your goodness becomes their discount. Your integrity becomes their leverage. Meanwhile, the person who treats business decisions as strategic calculations rather than moral referendums is setting prices based on perceived value, negotiating from positions of strength, and capturing the premium you're leaving on the table out of misplaced nobility. Stop justifying your financial decisions with morality. Start asking one question instead. Does this move me closer to wealth? Not, does this make me look noble to people who aren't writing my checks? Picture 2 entrepreneurs with identical products. The first refuses to raise prices because he doesn't want to appear greedy. He keeps his margins thin, his positioning humble, his value proposition apologetic. He works twice as hard for half the money and tells himself he's building authentic relationships. The second doubles her pricing, improves the perception of exclusivity through scarcity and positioning, and triples her profit while working fewer hours. She understands something fundamental. Price isn't about cost. It's about narrative. People don't buy what things cost to make. They buy what things mean, and meaning is entirely constructed through positioning, presentation, and perceived value. Who survives when the market tightens? Who scales when opportunity expands? Always the one who controls the perception of value rather than apologizing for it. The market doesn't reward your goodness. It rewards whoever controls the perception of value. This is the first Machiavellian truth you must internalize until it becomes instinct. Your moral superiority feels good in the moment, but it compounds into financial mediocrity over years. Every time you undercharge out of guilt, every time you over-deliver without capturing the premium, every time you justify your worth with effort instead of results, you're training the market to devalue you. And here's the cruelest part. The market will oblige. It will happily accept your virtue as payment while directing actual money to people who understand that business is theater, value is perception, and the performance matters more than the backstage reality. Machiavelli knew that appearing powerful generates actual power. In wealth, appearing valuable generates actual value. The person who masters this principle doesn't work harder. They work the perception, and the perception does the heavy lifting. Now the second principle. Appearing wealthy is more profitable than being wealthy. Machiavelli understood this instinctively. The appearance of power generates real power. A prince who looked weak even if secretly strong, would be challenged constantly. A prince who projected strength, even if internally vulnerable, commanded respect and compliance. In wealth, the exact same dynamic operates. The perception you project opens doors, attracts opportunities, and creates credibility before you've proven a single result. This isn't about fake it till you make it delusion. This is about understanding that humans make decisions based on pattern recognition and social proof, not objective analysis. When you walk into a room looking like someone who's already won, people's brains automatically assign you competence, reliability, and insider knowledge. When you walk in looking like you're still figuring it out, they assign you risk, inexperience, and desperation. Both assessments happen in seconds before you've said a word, and they determine everything that follows. Invest strategically in symbols of status that generate measurable returns. This isn't vanity, it's infrastructure. The right clothes in decisive meetings, professional environments that signal credibility and permanence, body language that communicates you've already achieved what they're still chasing, a website that looks like you charge 10 times what you actually do. These aren't expenses. They're tools that reshape how value flows toward you. Imagine walking into a room of potential investors. Version A, humble, understated, overly honest about challenges and uncertainties. You're authentic, vulnerable, real. You explain exactly why you need their money and what could go wrong. Version B, confident, dressed with precision, speaking like someone who already possesses what they desire. You don't ask for investment. You offer access to an opportunity that's moving forward with or without them. You create subtle urgency. You reference other interested parties. You frame it as their potential loss, not your desperate need. Which version gets the check? Always the one that appears inevitable. Wealth attracts wealth, but only after you learn to dress like someone who already possesses it. This isn't about designer labels or luxury signaling for its own sake. It's about understanding that perception is the gate that controls access to opportunity. The person who looks like they're still climbing gets advice, encouragement, and maybe a small chance if they prove themselves first. The person who looks like they've already arrived gets partnerships, introductions, and capital. Same room, same opportunity, entirely different treatment based purely on projected status. Machiavelli would recognize this immediately. The appearance of belonging to the winning side makes you a magnet for people who want to align with winners. And once you're in those rooms, once you have access to those conversations, the actual wealth building becomes exponentially easier. You're no longer pushing uphill against skepticism. You're being pulled forward by people who've already decided you're worth their attention. The third principle cuts even deeper. Loyalty is expensive. Choose strategic allies. Machiavelli warned repeatedly that blind loyalty is weakness disguised as virtue. A prince who rewards loyalty over competence fills his court with grateful yes-men and loses to the rival who built a team of brutal specialists. In money, surrounding yourself with people based on affection rather than strategic value is charity disguised as networking. It feels good, it makes you seem loyal and decent, and it slowly bankrupts you while competitors build alliances based on capability and mutual leverage. This is one of the hardest pills to swallow because we're socialized to value loyalty above almost everything else. But Machiavelli understood that sentiment is a luxury that winners can't afford when the stakes are existential, and your financial future is existential. Every relationship that consumes energy without producing value is directly stealing from your family's security. Audit your circle with brutal honesty. Who actually challenges you to think bigger? Who connects you to opportunities you couldn't access alone? Who brings skills or knowledge or relationships that multiply your leverage? And on the other side, who only consumes your time and energy? Who pulls you into drama and emotional management? Who makes you feel good about staying exactly where you are? Cut without guilt. This isn't cruelty, it's resource allocation. Riqueza demands high-value transactional relationships where both parties gain strategic advantage. Picture this. You maintain a business partner who's been your friend since childhood, but he doesn't deliver results. You keep him out of loyalty, out of history, out of the belief that abandoning him would make you a bad person. Meanwhile, your competitor forms alliances with ruthless specialists, people who bring complementary skills and connections, people chosen purely for strategic fit. 18 months later, that competitor has lapped you twice. Your sentimental loyalty cost you competitive advantage, market share, and possibly your business. The friendship didn't protect you. It made you vulnerable. In the wealth game, sentiment is luxury. Strategy is survival. Machiavelli didn't say abandon everyone who isn't immediately useful. He said understand the difference between emotional attachment and strategic alliance, and never confuse the two. Your family, your true friends, those relationships exist outside the game and deserve full loyalty. But your business relationships, your professional network, your partnerships, those must be evaluated on performance and mutual value creation. The moment you start keeping people around because of guilt or history, or the story you tell yourself about being loyal, you've stopped being strategic, and the market punishes lack of strategy with mathematical precision. This doesn't make you cold, it makes you serious. It means you understand that protecting your financial future sometimes requires disappointing people who expected you to stay small and accommodating forever. The fourth principle reveals why most people stay trapped. Time isn't money, systems are. Machiavelli built structures of power that functioned without his constant presence. He understood that real control comes from creating mechanisms that operate independently, generating results whether you're in the room or not. Wealth follows the same logic exactly. Real wealth doesn't come from trading hours for dollars, no matter how high your hourly rate climbs. It comes from systems that generate results while you sleep, assets that appreciate, automations that sell, teams that execute, intellectual property that compounds. The professional who makes $50,000 a month but has to work harder to make more is trapped in a high-income prison. The professional who makes $30,000 a month from a system that runs itself has something infinitely more valuable: leverage. Time, freedom, the ability to build the next asset instead of being chained to servicing the current one. Stop trading hours for money. Start building something that scales beyond your physical presence. This is the dividing line between high earners and wealthy people. High earners optimize their time. Wealthy people make their time irrelevant to their income. Create a digital product that sells automatically. Build a business with a team that executes your vision without your micromanagement. Invest in income-generating assets, real estate, dividend portfolios, businesses you own but don't operate. Develop a personal brand that opens opportunities while you're doing something else entirely. Every hour you spend executing tasks instead of building systems is an hour you've chosen short-term income over long-term wealth. Picture professional A, who invoices $50,000 monthly but needs to work 60 hours a week to maintain it. One vacation, one illness, one burnout, and the income stops. Now picture professional B, who generates $30,000 monthly from an online course that sells itself, spending her actual time building the next scalable asset. 3 years later, professional A is still working 60-hour weeks at marginally higher rates. Professional B has 4 income streams, works 20 hours weekly, and her net worth has multiplied exponentially. Who understands wealth? Wealth isn't how much you earn. It's how much you earn without being present. This is Machiavellian thinking applied to economics. Build the machine. Don't be the machine. The moment your income requires your constant attention, you don't have a wealth-building asset. You have an expensive job. Machiavelli would look at someone grinding 80 hours weekly and see a peasant with a good salary, not a person positioned for actual power. Because power, like wealth, comes from controlling systems that work for you, not from being the hardest working component in someone else's system. Every wealthy person eventually learns this, either through insight or exhaustion. The only question is whether you learn it early enough to benefit from the compound effect, or late enough that you've already spent your best years trapped in the high-income hamster wheel. The fifth principle is where Machiavelli gets genuinely uncomfortable. Fear is more effective than love. He wrote explicitly that if a prince cannot be both loved and feared, it's far safer to be feared. People violate love easily, but fear of consequences creates reliable behavior. In the market, brands and individuals who generate urgency, exclusivity, and FOMO fear of missing out, sell more than those who beg for permission or plead for attention. The consultant who's always available, always accommodating, always grateful for any opportunity gets treated like a commodity. The consultant who books 60 days in advance, establishes clear boundaries, and charges premium rates because access is scarce gets treated like an authority. Same skills, same services, completely different outcomes. Why? Because scarcity triggers psychological value assessment. When something is readily available, our brains categorize it as common and therefore cheap. When something is difficult to access, we automatically assign it higher value and importance. Create artificial scarcity strategically. Limit slots, establish deadlines, make yourself difficult to access before you make yourself available. This isn't manipulation, it's understanding how human psychology interfaces with value perception. If you're always available, you train everyone around you to believe you're not in demand. And if you're not in demand, you can't command premium positioning or pricing. Picture two consultants offering identical expertise. Consultant 1 responds immediately to every inquiry, accepts clients on rolling basis, and emphasizes flexibility and accommodation. Consultant 2 books consultations 30 to 60 days out, accepts only limited clients per quarter, and frames access as competitive. Who gets perceived as the authority? Who charges double or triple? Always the one controlling access, because fear of losing the opportunity creates more motivation than hope of gaining approval. Machiavelli understood this about human nature 5 centuries ago. It hasn't changed, it won't change. Whoever is always available is never valued. This is brutal but mathematically provable. Your availability signals your desperation, and desperation repels premium opportunities while attracting extraction. The person who establishes scarcity of their time, their attention, their services, forces others to compete for access, which automatically elevates perceived value. You don't become scarce by accident. You become scarce by design, by saying no more often than yes, by building systems that filter access, by understanding that your time is the only truly non-renewable resource you possess. Machiavelli would recognize this immediately as the same principle that governed access to princes. The harder you were to reach, the more valuable the audience became, and the more you could demand in exchange for access. Apply this to your professional life, and everything changes. Your time becomes precious because you've made it expensive. Your attention becomes valuable because you've made it rare. The 6th principle addresses the death trap of rigidity. Adaptation defeats rigid principles. Machiavelli was ruthlessly pragmatic. Changing strategy based on shifting circumstances wasn't betrayal. It was intelligence. Sticking to outdated approaches out of pride or consistency was the mark of someone about to lose everything. In money, whoever clings to how it's always been done dies when the market shifts, and the market always shifts. The business model that printed money in 2023 might be obsolete by 2025. The skill that made you valuable yesterday might be automated tomorrow. The platform that built your audience could collapse or change its algorithm overnight. Adaptation isn't optional, it's the price of continued relevance. Yet most people would rather fail with their principles intact than succeed by changing course. Machiavelli would find this baffling. Principles don't pay your mortgage, results do. Reevaluate your income sources quarterly. What worked last year deserves skepticism, not loyalty. Where is the market moving? What's emerging? What's dying? Pivot without ego, without attachment to past success, without the need to be right about predictions you made when circumstances were different. Imagine an entrepreneur who invests years building an analog business model, perfecting every detail, becoming the absolute best at an approach the market is abandoning. Meanwhile, a competitor launches a digital version, scales globally with minimal overhead, and dominates the entire niche in 18 months. The first entrepreneur had better execution, deeper expertise, stronger work ethic, and went bankrupt anyway. Because principles don't protect you when you're ignoring reality. The market doesn't care about your commitment to the old way. It rewards whoever solves the current problem most effectively, regardless of how recently they arrived or how much they had to change to get there. Wealth belongs to those who adapt, not those who resist. Machiavelli watched princes lose kingdoms because they couldn't adjust to new military technologies, new political realities, new power structures. The same dynamic operates in your bank account. Every attachment to how things should work is a liability when reality has moved on. The people accumulating wealth right now aren't necessarily smarter or more talented than you. They're just more willing to abandon approaches that stopped working, even if those approaches built their identity. They update their models, they learn new skills, they migrate to new platforms. They're not emotionally invested in being right about the past. They're strategically committed to winning in the present. That flexibility, that pragmatic ruthlessness about changing course, is what separates those who build lasting wealth from those who had one good run and spent the rest of their lives wondering what happened. The seventh principle synthesizes everything. Fortune favors the prepared, but only those who act. Machiavelli wrote about virtù, meaning capability and decisive action, and fortuna, meaning luck and circumstance. Wealth requires both. You need technical preparation, skills, capital, knowledge, relationships, so you're ready when opportunity appears. But preparation alone accomplishes nothing. You also need brutal courage to act immediately when the window opens. Opportunity doesn't wait for people who need to think about it longer, who need to consult more advisors, who need perfect certainty before moving. The moment of maximum opportunity is usually the moment of maximum fear, when everyone else is paralyzed. And if you hesitate, someone with less preparation but more decisiveness will take the position that should have been yours. Machiavelli understood that timing is everything, and timing belongs to whoever moves first and fastest when conditions align. Study obsessively, accumulate capital, develop rare and valuable skills, build relationships before you need them. Position yourself so that when the door opens, you're standing right there with resources ready to deploy. Then, when that moment arrives, when prices crash and everyone's panicking, when a partnership opportunity emerges unexpectedly, when the exact opening you've been preparing for finally appears, enter without hesitation. Don't poll your friends. Don't wait for more data. Don't talk yourself into caution. Act. Picture an investor who spends years studying market cycles, learning to read signals, building cash reserves, controlling emotions. Then a crash happens. Prices plummet. Fear is universal. Everyone's selling, and he has both the capital and the courage to buy aggressively, while others are frozen in terror or convinced the world is ending. 3 years later, his positions have tripled. He didn't get lucky, he got prepared, then got decisive. That combination is where wealth concentrates. Luck is when preparation meets immediate decision. Most people have one or the other. They're either prepared but timid, or bold but unprepared. Machiavelli understood that virtù without fortuna is wasted potential, and fortuna without virtù is squandered opportunity. You need both. Build the capability, then deploy it without mercy when timing aligns. The people who capture disproportionate wealth aren't working from some secret playbook you don't have access to. They simply prepared differently and acted faster when everyone else was paralyzed by uncertainty. If you're waiting for perfect clarity before moving, you're waiting forever. Wealth goes to those who act on good enough information at the right moment, not those who wait for certainty that never arrives. Now, if this is making sense, if you're starting to see the actual game underneath the morality story you were sold, save this video. You'll want to revisit these principles when you're making the decisions that determine your financial trajectory. Let me show you exactly how this works in reality. Picture two entrepreneurs presenting identical projects to the same investor, same product, same market, same potential. The first entrepreneur walks in technically competent and painfully honest. He explains every detail of the business model, walks through the spreadsheets line by line, admits every risk and uncertainty because transparency is important to him. When the investor asks about valuation, he hesitates. He's clearly uncomfortable talking about money. He explains his costs, justifies his numbers with effort and hours invested, then says something like, "I just need someone to believe in this," or "I only need support to get to the next level." His pitch is essentially a request for validation disguised as a business proposal. He positions himself as someone who needs rescue, someone asking for a chance. The investor listens politely, asks thoughtful questions, even seems engaged, but the decision was made in the first 90 seconds. It's a no, not because the business is bad, but because desperation repels capital and uncertainty signals risk. Now the second entrepreneur enters the same room. She doesn't rush to fill silence. She lets it sit there, creating weight. When she speaks, she's not asking for anything. She's offering access to something that's moving forward, regardless of this conversation's outcome. She talks about the return as inevitable, not hopeful. She shows traction, even if it's modest. Customers who paid, metrics that moved, proof that the market responds to what she's building. She doesn't explain why she deserves investment. She demonstrates why this opportunity is scarce and time-sensitive. Midway through, she mentions casually that 2 other investors are reviewing terms this week, and she needs to make a decision by Friday. Then she closes with a frame flip. So, are you in, or should I move forward with the parties who've already signaled commitment? She's not begging, she's qualifying him. She's positioned the opportunity as his potential loss, not her desperate need. The investor transfers capital within 48 hours, not because her business was objectively better. Remember, the projects were identical. He invested because she controlled the narrative. She understood what Machiavelli knew instinctively. Whoever controls the frame controls the outcome. The first entrepreneur handed the investor all the power by positioning himself as supplicant. The second entrepreneur retained power by framing access as the scarce resource. Same room, same product, same capital available. Entirely different results based purely on understanding the psychological game underneath the business transaction. This is what separates people who get funded from people who get encouraged. This is what separates those who close deals from those who get endless coffee meetings that go nowhere. The market doesn't reward your honesty or your need. It rewards whoever demonstrates that they're moving forward with momentum, with or without any particular person's participation. Here's what you need to understand. Both entrepreneurs had the exact same product. Both had done the work. Both had legitimate businesses worth funding. The only difference was who understood Machiavelli's core insight, that reality matters less than the perception you construct around reality. One person walked in carrying the burden of proving worthiness. The other walked in offering access to something valuable. One saw the meeting as a test they might fail. The other saw it as an evaluation of whether the investor deserved the opportunity. That frame, that fundamental shift in how you position yourself relative to money and power is the difference between building wealth and spending your life wondering why it never happened, despite your competence. You weren't less skilled. You weren't less dedicated. You just didn't know the actual rules. And the actual rules have nothing to do with fairness or meritocracy or cosmic justice rewarding good people. The rules are Machiavellian. Control perception, create scarcity, demonstrate momentum, never negotiate from need. Before you learned this, you were playing a game where effort equals outcome, where virtue gets rewarded, where the universe keeps score and eventually balances the scales in favor of decent people who work hard. That world doesn't exist. It never existed. After you understand this, you're playing a different game entirely. One where positioning beats effort, where narrative beats truth, where strategic ruthlessness beats moral consistency. You now see that the wealthy aren't better people. They're people who stopped confusing goodness with effectiveness. They accepted that money flows toward power, and power comes from controlling systems, perceptions, and access. They learned to build machines instead of being machines. They surrounded themselves with strategic allies instead of sentimental ones. They became scarce instead of available. They adapted when the market shifted instead of dying with their principles intact. And when opportunity emerged, they acted immediately instead of deliberating until someone else took the position. Think of it like this. You've been playing chess believing the goal was to move your pieces beautifully, honorably, with integrity. You kept your word even when it cost you advantage. You played fair even when your opponent didn't. You felt good about your character, and you kept losing. Now you understand the actual goal. Checkmate. Not the most virtuous path to checkmate. Not the most transparent or humble or fair checkmate. Just checkmate by whatever legal strategy works fastest and most effectively. Machiavelli wasn't teaching immorality. He was teaching the difference between feeling righteous and achieving results. And once you see that distinction, you can't unsee it. You'll watch people around you continuing to confuse character with strategy, and you'll recognize exactly why they stay stuck. Not because they're not good enough, because they're playing the wrong game with obsolete rules while telling themselves their suffering proves their virtue. So let's bring this back to where we started. Wealth doesn't reward those who work harder. It rewards those who understand the game. You now know the 7 Machiavellian principles that separate wealth builders from people trapped in the illusion of unrewarded effort. Virtue doesn't pay bills. Stop justifying financial decisions with morality and start asking what moves you closer to actual wealth. Appearing wealthy opens more doors than being wealthy in silence. Invest strategically in the perception that attracts opportunity. Loyalty is expensive. Audit your circle and keep only those who provide strategic value. Time isn't money. Systems are. Build assets that generate results without your presence. Fear is more effective than love. Create scarcity and make yourself difficult to access. Adaptation defeats rigid principles. Pivot ruthlessly when the market shifts, and fortune favors the prepared who act. Build capability, then deploy it without hesitation when timing aligns. These aren't theories. These are the operational principles that govern every wealth transfer happening right now. While we're speaking, you have a choice in this exact moment. You can close this video and return to the comfortable story that good people who work hard eventually get rewarded, that your virtue will somehow transmute into prosperity, that the universe is keeping score and your turn is coming. Or you can accept what Machiavelli understood 5 centuries ago and what every wealthy person has learned either consciously or intuitively. The game has rules. The rules are not fair, and knowing them beats deserving them every single time. You now possess information that most people will never hear because it's too uncomfortable, too cynical, too far from the fairy tale we're all sold about meritocracy and justice. What you do with this information determines everything. Apply it, and you'll start seeing opportunities that were always there, but invisible because you were looking through the wrong framework. Ignore it, and you'll spend the rest of your life working harder than the people who pass you financially, wondering what secret they knew that you didn't. Now you know the secret. The only question left is whether you have the courage to use it.